So, Federal Chair Jerome Powell is speaking in front of Congress today. I want to go over what was said, what's going on, and let's just jump right in. These are the headlines. Jay Powell pushes back on calls for Federal Reserve rate cuts as soon as July. And essentially, there were a couple people in the Fed that were saying, hey, we should cut next month. But Powell's like, meh, not so fast. There was also this weird exchange with a baby. I'm not kidding, that I've never seen before in a Fed meeting. And I got to watch it because no one else seems to be showing it. Let's watch.
Now they're holding steady. Can you talk about why the instability? When we look at tariffs around the increase in the deficit by the proposed big ugly bill that is being brought through Congress right now, and increasing our debt by trillions of dollars, and having our credit downgraded again because we are increasing our deficit. So with this economic uncertainty, where we were going, we were on the way down for reducing our rates, and now we have to hold steady to address the instability. Is that correct?
I'm sorry, could you just briefly restate your question there? I apologize.
Yes, I'm going to do this the best I can with with Sam here.
What?
That with our
Okay, I had to show that because I'm just like, this is the most bizarre thing I've ever seen at a Fed hearing or any hearing. And I want to be frank, guys. I'm not against babies. I'm not against women. I just want to make that clear. Just in this context, it just seems really strange to bring your kid and you're jumping up and down in Federal Powell. So that's how this thing started out, and I was like, okay. Let's not show the Congress people. And it was all over the map. It was 3 hours. If you want to watch the whole thing, you can. We'll just cut to the most important parts, which one was, yes, that was kind of insane. But what did Federal Chair Powell say about tariffs and Trump policy, these kind of things? And let's see.
Is that your understanding? Do you anticipate there may be impacts down the road?
Yeah, that's very much what I hear. It happened to meet with an unusually large number of business people in this last FOMC cycle, and that's a typical thing that they'll say, especially the retailers, that what's being sold now was in inventory in February, let's say, and it just isn't showing up yet. So we do expect to show up, tariff inflation to show up more, but I want to be honest, we really don't know how much of that's going to be passed through to the consumers. We just don't know, and we won't know until we see it. It could be lower than we expect. It could be higher. We have to wait and see, which is kind of what we're doing.
So basically what we're talking about is how much of the tariffs are the customers going to eat. That's basically what it boils down to. And we know that most likely you're going to see it because we've seen it in the past, and you'll see it again where, yes, the cost will be passed on to you. I'll just say this, here in Korea, when I order something on Amazon, the Amazon site actually shows you this is the cost. You're going to pay the tariff. you're going to pay the tax. And I think people have been saying that Temu and maybe Alibaba have been doing a similar kind of thing, that basically you'll see that you're going to pay it. So it's clearly going to be passed on to you. The other thing as well is consumers, they're starting to feel kind of nervous about the future. This was a new thing that just came out. Survey shows U.S. consumers' confidence worsened in June. And are we signaling a recession here? So one, it says consumer confidence index fell to 93, right? And that was actually a surprise. I guess Wall Street was expecting it to go up to 99. And then you have different things. You have like, okay, what are you feeling about today? And then what are you feeling about the future? And so then forward-looking, it says surveys forward-looking expectations index fell to 69 from 73. And then that value is below 80 signal a recession ahead. So that's what you need to know. Consumers are not feeling so great. But if you guys, sure, you go to the store, you see these things are still expensive. You talk to your friends, you see people are getting laid off. It's not hard to figure out, right? And one of the things that we're trying to figure out right now is where the tariff's going to be in the future. And it's so uncertain under Trump because he changes his mind like every minute with whatever tweet. You also have the war concerns, oil costs. Oil barrel was skyrocketing with threats of the possible conflict continuing with Iran and Israel. What was Iran going to do? Then USA jumped in, right? Was Iran going to shut down the canal? What was up? The consumer confidence has been falling. You guys can see the chart right there. And we're going to see, let's see what more Jerome Powell has to say, because he has some interesting stuff to say about, again, the tariffs, inflation, et cetera.
I appreciate the uncertainty. Another thing he told me that had me very concerned was that often they will increase prices on goods not subjected to tariffs to compensate for the very substantial losses that they have to suffer with the increase of tariffs on relatively price elastic goods. So in other words, necessities will also tend to bear a higher price, even if they're not subjected to tariffs. Is that your understanding of the potential impacts?
You know, that very much is something that companies will tell you that they do. If they can't cover the losses on the thing that's being tariffed, they'll find other ways to do it. We actually don't have prominent examples of that yet, but that's certainly a possibility. And that did happen in the last tariff episode with washing machines and dryers.
So this was actually really an interesting part of the discussion. Basically, we're talking about, okay, sometimes companies can't raise the price because if they raise the price on something, you're not going to buy it. And so what the company would do then would be take a loss on a particular product and then raise the price on something else. And this is something that we'll probably most likely see. Also, I think, you know, the way that our world is going these days, and I'm sure we talk about all the time, is that companies are really concerned about, you know, making the stock market happy, making Wall Street happy, and basically always trying to push profits. But that's the catch, is if they raise prices too much, people just won't buy. And so so then you got to like try to balance that out. But this whole discussion of, hey, take losses on some products, make more profits on others, that's something that businesses, you know, do all the time. I'm sure you guys know this. For anyone who's ever worked in you know, retail, et cetera, you know these kind of things.
Well, look, as I said earlier, if you just look at the basic data and don't look at the forecast, you would say that we would have continued cutting. The difference, of course, is at this time, all forecasters are expecting pretty soon that some significant inflation will show up from tariffs. Now, and you know, we can't just ignore that, but we're just saying let's wait and see more. That's all we're doing. And if you will have noticed, a substantial majority of the committee has written down rate cuts in the remaining 4 meetings this year.
And I don't know if that was a slip up, you know, by Powell. It's like, well, you know, in the next 4 years we're going to try to cut, but you know, he meant to say the next year. The general forecast that I've been hearing is maybe 2 cuts this year. I mean, anything can change. You know, honestly, just listen to Powell speak and just kind of knowing what's going on with Trump, I would, if you're the Fed, just hold. You could theoretically raise here. They're in a tough spot because you just don't know what Trump's going to do. You see the tariffs coming, and then the other thing is like you could have a wave of unemployment. No, for real. And you know, be it with remember before they're trying to fire all these people in the Fed. If things get really, really ugly, and you know, businesses are in massive uncertainty because again, due to Trump and also the slowing economies around the world, they're not going to be hiring anymore. And I've already been seeing reports that this summer is really tough for young people. So, you know, the Fed's kind of in a tough spot. Just wait, probably. And that's literally what Powell's saying. It was interesting, though, that a couple of the Fed members did come out and, you know, say, hey, let's cut, because the worries is that things are slowing too much in the economy and that we need to get the money borrowing going again. That's basically what it ends up being.
So it's just a question of being prudent and careful. But at a time when the labor market is still strong, we don't see weakness in the labor market. If we did, that would change things. You know, we're going to continue to adapt as the data adapt. But that is the difference between then and now.
Well, it's interesting that, so he's saying they don't see labor weakness in the labor market, and I want to hear from you guys on the ground. My, you know, basic understanding of how people are feeling is just basically your jobs don't pay enough. And there are jobs out there, right? So even if the unemployment, you know, numbers like aren't, you know, bleak, like people are finding a job, but you just feel like the job that you have doesn't pay enough to pay for your daily living expenses. This, however, does certainly matter in which market you're in and sort of, you know, where you live, meaning, and also like which housing market and also which industry you're in. But I've been seeing a lot of slowdowns in tech and financial. And then, you know, people are essentially looking for lower paying jobs, basically. So, you know, they always say that the job market is not as weak as, you know, or he'll say the job market remains strong. But I always question that stuff because I just know one of the key indicators for me is look at the median salary that people make, and then look at the median price of house, and there's just a massive disconnect in affordability, which I think you guys already know.
Then inflation was forecasted to continue to come down. Here it's forecasted to go up by all forecasters. So, and again, we're not overreacting to that. We're just saying, hey, as long as the economy's strong, we can take a little bit of a pause here. And that's what we're doing. And again, continue to adapt as the data comes in. If we see data that suggests that inflation's not going to produce big increases, that would matter. And if we saw the labor market weakening, that would matter too.
So that's sort of where we are at right now. I know the markets are absolutely wild and insane. I'll just tell you guys, we have a bit of money in here in Korea, and our markets have been actually been going up the last couple of months, like double digit, which is kind of crazy. And essentially, in my opinion on this stuff, you got to do what makes sense for you in terms of your, risk factor. I do see markets in the USA are still up. I think the NASDAQ was reaching the all-time high. In my opinion, this stuff, some of these things are really disconnected from reality. So if you take a look at the Tesla, which for example is a hot stock in the market, I just made a video about it before, like it's all based on this robots and AI and robotaxi. And there's a lot of companies out there like that. It's all based on hype. And when you actually see the technology, you're like, oh my God, is this what we're investing in? Like all of this craziness. And essentially a way to insulate yourself from being overexposed from too much hype. Index funds work pretty well. However, just there's a caveat there is that they tend to be overly tech heavy these days. So if you want to go balanced fund, you can do something like that, a balanced index fund. If you want to go bonds, you can do something like that, works pretty well. CDs aren't paying bad these days. I was just looking at the rates. I think it's like 4.3, 4.4. Bonds are kind of roughly the same bit. And keep some cash in hand and pay off some debt. So, generally speaking with all this stuff, don't put all your eggs in one basket, especially in this market, because I think there is still a lot of bubbles out there. As I see people are yet still in crypto, which to me, I'm not in that stuff, but I get it. As long as things only go up, everything seems great. But when you look at sort of what the Fed is saying, you can see there's certainly a lot of craziness ahead, and Trump is still president, and we've been doing all sorts of craziness with in the Middle East and whether or not we are going to continue fighting there, ceasefire this, ceasefire that. And that's what's going on. So I want to hear your thoughts. I do appreciate your time, and I'll catch you on the next video.